The landscape of regulatory reform is now truly global and increasing in scope. While strict global anti-money laundering and know your customer requirements have been with us for a while, laws and regulations aimed at ending global tax evasion are a more recent phenomenon. The US tax authorities have been concerned for some time that US taxpayers are evading tax by investing money in foreign institutions, either directly or through foreign entities. In response to those concerns, the Foreign Account Tax Compliance Act, FATCA, was enacted in 2010 in the US and will be enforced from the 1st of July 2014. FATCA is a complex set of tax regulations, but its objective is simple: to make it more difficult for US persons to avoid tax by investing in foreign institutions, either directly or through foreign entities anywhere around the globe. FATCA is global and extraterritorial in nature and requires both US and non-US financial institutions and other financial intermediaries to become tax collection and information gathering agents on behalf of the US government. FATCA generally requires financial institutions to classify all account holders, both individuals and entities, as either US or non-US. This increases the complexity of customer identification and documentation processes and increases the burden of proof on the financial institutions. To provide an idea of scale, between 50,000 and 100,000 global institutions will be classed as foreign financial institutions, or FFIs, including banks, asset managers, insurers, and so on. For example, one of the requirements for FFIs is to inform the US tax authorities of offshore accounts above certain US dollar thresholds held by US persons. FATCA also places an onus on the FFI to inform the US tax authorities on the income earned by US persons, information previously only provided by US taxpayers. Now, this has wide-reaching implications on the way global financial institutions operate and their relationships with clients. Besides the reputational risks and inability to operate in some markets, the FATCA regulations have a strong compliance lever in the form of a 30% withholding penalty. This is payable to the US authorities in two cases. Firstly, FATCA institutions are required to withhold 30% on all US source payments made to non-complying financial institutions. Secondly, FFIs may be required to withhold 30% of US sourced income where customers do not hold adequate documentation. And finally, an affiliated group of financial institutions is only FATCA compliant if every company in the group is compliant. Failure by one subsidiary to be compliant taints the entire group. Everyone who works for Metlife is responsible for complying with FATCA. To comply, you cannot coach, direct, encourage, or assist customers on ways to avoid FATCA. Coaching customers is prohibited and will not be tolerated by Metlife. The following are some examples of coaching behaviours which are not allowed. Suggesting customers split up accounts to avoid classification as a high-value FATCA account. Recommending holders of US accounts close, transfer, or withdraw money from their accounts to avoid reporting. Encouraging account holders to remove US indicia from their account information, or intentionally not disclosing or accurately capturing a known US account. Facilitating the manipulation of account balances or values to avoid FATCA thresholds. Metlife is firmly committed to comply with FATCA and has zero tolerance for any avoidance of tax liability. In summary, FATCA is not just another tax issue that impacts compliance activities. FATCA is one of the most ambitious, comprehensive, and complex information reporting regimes in the world. It touches the whole value chain and requires completely new and extended information and reporting systems. Everyone who works for Metlife is responsible for complying with FATCA. Implementing FATCA compliance within Metlife requires the education and cooperation of all of us to work together to achieve compliance.